In 2013, the average CEO of a Fortune 500 company was earning 331 times the salary of their average employee. It is the golden rule of modern business. Maximize shareholder value at any cost. Squeeze the suppliers. Cap the wages. Cut the benefits. If the stock price goes up, you have done your job. But in Austin, Texas, the CEO of a Fortune 300 giant was breaking every single one of these rules. He didn't fly in a private jet. He flew commercial. He didn't hide his salary. He published it for every cashier and stocker to see. And most shockingly, he had capped his own pay and the pay of every executive in his company at just 19 times the average worker's wage. Wall Street analysts called him a socialist. They called his business model unsustainable hippie idealism. They said you cannot build a billion-dollar empire by being nice. And yet, for 30 years, his company didn't just survive. It grew faster, traded higher, and generated more profit per square foot than almost any traditional competitor in its sector. His name is John Mackey. The company is Whole Foods Market. And he proved that everything we are taught in business school about the purpose of a corporation is not just wrong, it's actually losing you money. Today, we are unlocking the strategy of conscious capitalism. To understand the magnitude of this strategy, you have to look at where it started. In 1978, John Mackey was a college dropout living in a vegetarian co-op. He borrowed money to open a small natural food store called Saferway. It wasn't a business. It was a mission. He wanted to sell healthy food to people. That's it. But fast forward 3 decades, and that little store had eaten the grocery industry alive. By 2013, Whole Foods had over 350 stores and sales topping $12 billion. It forced giants like Walmart and Kroger to completely overhaul their supply chains just to keep up. So here is the question we are answering today. How did a company explicitly designed not to prioritize profit end up making so much of it? How did a philosophy based on love, purpose, and happiness survive in the brutal, low-margin world of grocery retail, where pennies usually dictate survival? The answer lies in a counterintuitive framework Mackey calls conscious capitalism. It's a strategy that proves the zero-sum game of business is a lie. You don't have to take from employees to give to investors. You don't have to squeeze suppliers to lower prices. We are going to break down the 4 pillars of this strategy and reveal the specific insider secret that allowed Whole Foods to turn ethics into a competitive weapon. The first pillar of Mackey's strategy is what he calls higher purpose. Now, before you roll your eyes, understand that in the Whole Foods model, purpose isn't a marketing slogan. It is a functional economic asset. In a traditional company, the purpose is to make money. The product, whether it's cars, software, or kale, is just a means to that end. Mackey flipped the equation. He argued that just as a doctor needs to make money to live, but doesn't live to make money, a business needs profit to survive, but shouldn't exist just for profit. When your purpose is to nourish people and the planet, it changes who you hire and how they work. Whole Foods didn't just hire cashiers. They hired believers. This created a workforce that was intrinsically motivated. They weren't selling groceries. They were part of a movement. This drastically lowered turnover. In the grocery industry, employee turnover can be over 100 per year. At Whole Foods, it was consistently a fraction of that. Lower turnover means lower training costs, higher expertise, and better customer service. That purpose wasn't fluff, it was a cost-saving mechanism. This leads us to the second, and arguably most critical chapter. Stakeholder integration. Standard economic theory relies on the trade-off mentality. If you pay employees more, shareholders get less. If you pay suppliers more, customers pay more. It's a pie of a fixed size. Mackey's strategy was to reject the trade-off. He viewed business as an ecosystem. Let's look at how they treated suppliers. Most big-box retailers bully suppliers. They demand lower prices, squeeze margins, and delay payments. It's a hostile relationship. Whole Foods did the opposite. They treated suppliers as partners. They held local producer loan days, where they would actually lend money to small local farmers and brands to help them scale up. Why? Because when those small suppliers succeeded, Whole Foods got exclusive, high-quality products that Walmart couldn't touch. They created a unique supply chain that competitors couldn't copy because they were too busy bullying their own vendors. By helping suppliers win, Whole Foods won. By paying employees more and offering stock options to everyone, not just executives, the employees worked harder, reducing waste and theft. The pie didn't get sliced smaller. The pie got bigger. The engine that drove this was the third pillar: conscious culture. And the fuel for that culture was radical transparency. In most companies, salaries are a closely guarded secret. At Whole Foods, they practiced open book management. Any employee could look up exactly what anyone else in the company was paid, from the guy in the meat department to the regional president. This sounds terrifying to most HR managers. But Mackey argued that secrets breed distrust. If you are ashamed of what you pay someone, you are probably paying them unfairly. This transparency enforced the salary cap we mentioned in the hook. By capping executive pay at roughly 19 times the average worker's pay, Mackey ensured that leadership couldn't get rich unless the entire company got richer. This was tested in fire. In 2008, when the Great Recession hit, the stock market crashed. Most companies immediately initiated mass layoffs to protect their bottom line. Whole Foods didn't. Instead, the board and the executives voluntarily cut their own pay. They froze the dividend. They circled the wagons to protect the employees. The result: when the economy recovered, Whole Foods' workforce was loyal, energized, and ready to sprint, while competitors were still rebuilding the trust they had destroyed. And this brings us to the aha moment. The secret that John Mackey discovered isn't about charity. It's about the physics of business. Mackey calls it the paradox of profit. Think about happiness. If you wake up every day and say, "I am going to force myself to be happy," you will likely be miserable. Happiness is not a goal you can pursue directly. It is a byproduct of living a meaningful life. Mackey realized that profit works the same way. If you aim directly for profit, if you obsess over the quarterly earnings report, you start cutting corners. You degrade your products. You alienate your staff. You squeeze your customers. Eventually, you destroy the very thing that creates the profit. But if you aim for purpose, if you focus on maximizing value for the customer, the employee, and the supplier, the profit ensues. It follows as a natural byproduct of doing business well. The secret of Whole Foods wasn't that they were a grocery store. It was that they were playing an infinite game in a world of finite players. While Wall Street was looking at the next 3 months, Mackey was building a system that would compound for 30 years. And it worked. Until the wolves came. In 2017, an activist hedge fund called Jana Partners bought a massive stake in Whole Foods. They didn't care about conscious capitalism. They saw a company with bloated wages and inefficient supplier relations. They wanted to strip mine the company for short-term cash. Mackey faced a choice: let the hedge fund destroy the culture he built, or sell the company to someone who understood the infinite game. He chose Amazon. Not because he wanted to sell out, but because he viewed Amazon as a white knight, a company that, like Whole Foods, was obsessed with the long-term customer experience rather than short-term quarterly profits. He sold the company to save its soul. Before we discuss what this means for your business, I have a small favor to ask. If you're enjoying this breakdown of business strategy, please hit the like button and subscribe. It tells the algorithm that you value deep dive content, and it helps us unlock more strategies for you. So, what can we learn from John Mackey? We learn that business ethics is not an oxymoron. It is a competitive advantage. In a world where consumers are increasingly skeptical of corporate greed, the companies that will win the next decade are the ones that can prove they stand for something. The companies that treat their employees like partners, not expenses. The companies that understand that profit is the result of value creation, not the cause. You don't need to be a billion-dollar grocery chain to apply this. Whether you are a freelancer, a startup founder, or a manager, ask yourself, are you playing the finite game of squeezing out the next dollar? Or are you playing the infinite game of building a system that generates value for everyone it touches? Whole Foods proved that you don't have to choose between doing good and doing well. You just have to be conscious enough to see how they are connected. If you learn something new, hit the like button and subscribe for more strategy breakdowns. And let us know in the comments, what company's strategy should we unlock next?